everyone, it's Lauren Mack with a Hack in the Rat Race. And today I'm going to talk about the inverted yield curve. If you've been following the financial news lately, then you've probably been hearing a lot about the inverted yield curve. You may be wondering what exactly is an inverted yield curve, why is it gaining so much attention, and more importantly, how does it impact your life and investments? In today's video, we're going to talk about why this is so important and why it can indicate that a recession is on the way. I'll also talk about some things that you can do to remain financially healthy in the event of a recession. So let's jump right in. What exactly is the yield curve? When we talk about the yield curve, we're referring to the relationship between the short-term and long-term interest rates on fixed income securities, usually in the form of bonds issued by the U.S. Treasury. An inverted yield curve happens when short-term interest rates are higher than long-term interest rates. Most of the time, during normal economic cycles, the yield curve is not inverted since debt with longer maturities typically take higher interest rates than near-term ones. When we're talking about short-term interest rates and long-term interest rates, we're talking about the 2 and 10-year yields respectively. At the time of this video, the yield on the benchmark 10-year Treasury note climbed to 2.963%, while the yield on the 2-year sits at 3.164%, making an inversion in the yield curve. This is significant because an inverted yield curve is rather uncommon. It indicates the near term is riskier than the long term. Usually, in normal economic cycles, the short-term interest rates are lower than long-term interest rates, which causes the yield curve to slope upward, indicating higher yields for long-term investments. Meaning, the longer you loan your money to the U.S. government, the more interest you'll receive. Therefore, you would expect to receive more interest on a 10-year loan versus a 2-year loan. This is commonly considered to be a normal yield curve. When the spread between short-term and long-term interest rates begins to narrow, it causes the yield curve to flatten. Typically, a flat yield curve usually observed during the transition period from a normal yield curve to an inverted yield curve. So, why is this important and what does it mean for investors and the overall economy? Historically, an inverted yield curve has been seen by economists and investors that an economic recession is coming. As investors become concerned about an approaching recession, many investors will buy long-term treasury bonds based on the premise that they offer safety from a declining stock market. This helps investors protect their capital and hopefully have an opportunity for some appreciation in value as interest rates decline. As a result of the rotation to long-term bonds, yields can fall below short-term rates, forming an inverted yield curve, meaning you'd be getting more money for loaning to the government in the short term than in the long term. When the short-term interest rates rise above long-term interest rates, the general feeling in the market indicates that the long-term economic outlook is poor and that the yields for long-term bonds will continue to fall. The inversion of the yield has been a somewhat rare phenomenon, due largely to longer than normal cycles between recessions since the early 1990s. Economic cycles, regardless of their length, have usually swung from growth to recession and back again. Inverted yield curves are just part of these normal cycles. As a matter of fact, the yield curve has inverted each time before a recession since 1956. If we go back to 1900, the yield curve has inverted 28 times. And 22 times, a recession followed within 6 to 36 months. So, the inversion of the yield curve has only given us a false signal 6 times. If you're getting value from this video, don't forget to poke the like button. Now that we know what a yield curve is, what exactly does it mean for investors? Typically, when the yield curve inverts, profit margins usually fall for companies that borrow cash at short-term rates and lend at long-term rates, such as community banks. Also, hedge funds usually have to take on increased risk in order to generate the level of return they're after. Interestingly, when the yield curve inverts, it tends to have a less of an impact on consumer staples and healthcare companies. And this is because they're not interest rate dependent. When the yield curve inverts, many investors like to invest in defensive stocks. Some examples of these are food, oil industries, along with water, gas, electric utilities, which tend to be less affected by downturns in the economy. Some examples of defensive stocks are Walmart, Costco, FedEx, Procter & Gamble, CVS, you get the idea. Bread and butter stocks that are related to things that people need no matter what, like groceries, prescriptions, you get it. However, when the economy goes into a recession, it's often the best time to invest in the stock market in general. During economic downturns, stocks are usually a great value and are heavily discounted. Eventually, the economy will recover and stocks will go back up. So, if you invest for the long term, you can have an excellent opportunity to make a lot of money. I would like to state that I am not a financial advisor. You should always consult with your financial advisor before making any investments. That being said, if you don't have a financial advisor, I have a video called How to Get a Free Financial Advisor. I'll link to it above and in the show notes below. In addition to its impact on investors, an inverted yield curve also has an impact on consumers. As an example, consider home buyers who are financing the purchase of their property through an adjustable rate mortgage, otherwise known as an ARM loan. These types of loan have interest rate schedules that are periodically adjusted based on short-term interest rates. The payments on an ARM loan tend to rise. When this happens, fixed-rate mortgage loans can be more attractive and make more sense during this time than an ARM loan. Another area where consumers might be affected is with lines of credit. They're affected similarly to ARM loans where the interest rate adjusts. So, in both cases, borrowers will need to dedicate a bigger chunk of their income toward paying their existing debt. As a consumer, there are several things you can do to minimize the impact of a recession on your life and come out ahead. The one thing that I always recommend in all of my videos is that you have a 6-month emergency fund saved up in liquid cash that is sitting in a high-yield savings account. This is really important because you never know when you might get laid off from your job or have a big medical bill or other unforeseen event. If you have an emergency fund in place, then you can avoid having to go into debt in order to make ends meet. Another strategy that I always recommend and I always follow myself is to live below your means. Living below your means will ensure that you'll have enough money to save and continue to invest, especially in times of recession where there are often really good opportunities to invest. Another great way to protect yourself is pay down any high interest loans that you might have. Whether that's a high interest credit card, line of credit, whatever the case may be. It's a good idea to pay those down as quickly as possible to avoid high interest rate payments. Also, traditionally during recessions, unemployment begins to rise and people start losing their job. So I always recommend keeping your resume up to date and your feelers out for job opportunities. Not only can this help you in the time of a recession, but keeping your eye out for other opportunities and career advancements is another way to earn more money over your lifetime and allow you to be able to invest more and possibly retire early and get out of the rat race. Most people start investing and creating passive income by maximizing their salaries at their 9-to-5 jobs. Many economists and investors disagree on whether an inverted yield curve is always a strong indicator of a looming economic recession. For example, in 2019, the yield curve inverted, alarming economists about another downturn. In early 2020, the COVID-19 pandemic actually triggered a global recession. However, economists don't think that the yield curve was able to predict the pandemic or any other black swan type of events for that matter. The COVID-19 downturn did quickly rebound to record highs in the market through the beginning of 2022. So it's always a good idea to take these types of things with a grain of salt. No one can know what the future holds or how markets are going to respond to any particular type of event. Long-term investing is always the best investing strategy. On average, recessions last about 17 months. Many times after recessions, the markets go on to new highs. For example, the economic expansions that started in March of 1991, in November of 2001, in June of 2009, were 3 of the 4 longest economic growth periods since World War II. So, if you're a long-term investor, then short-term market movements won't be seen as disruptive, but rather the normal part of any business cycle. Before I get into some of the positives about an impending recession, I'd like to hear from you in the comments below. Do you think we're headed into another recession, or do you think this is a false alarm? Okay, as a more positive note, I would also like to add that while recessions can seem scary and they're not always fun, this is the time when true wealth can be made. Many new millionaires are born out of investing during recessions. Each one has been different, but each one has produced more millionaires. For example, in the dot-com crash of technology companies in 2000, if you invested in a quality technology stock or even other types of stocks that were down at the time, you would have made a lot of money. Since then, for example, Amazon stock has gone up 135,922%. And that is including the recent stock price drop, as you can see here. If someone would have invested $1,000 back then, they would easily have more than $1 million today. The next big crash was the housing crash of 2008. People that picked up property back then have doubled, tripled, in some cases probably quadrupled the return on investment. And the thing about real estate that I often talk about is the exponential increase of returns due to leverage. The mortgage. If you put $20,000 down on a $250,000 house and the value increases 10%, that's $25,000 return. If you invest $20,000 in, say, the market and it increases 10%, that is a $2,000 return. So as you can imagine, many millionaires, if not multimillionaires, were born out of the recession. Even the COVID crash in 2019, the S&P 500, even with the latest dip, has exploded. Look at stocks like Tesla. Again, a different type of crash, but again, many millionaires born out of that crash as well. Even if you don't become a millionaire right away, investing during these times and holding for the long term is where real wealth can be made. Now, if you're watching this and you have high interest debt with an adjustable interest rate like credit cards, and you want a super easy shortcut to pay it off faster, then watch this video right here.